Long before shiny coins or plastic cards existed, humanity faced a massive puzzle. How do you safely store hard-earned wealth when thieves lurk everywhere? The answer changed human history forever. Meet Leo, a curious young apprentice scribe living in ancient Mesopotamia. Surrounded by towering clay ziggurats and bustling markets, he is about to uncover the secret origins of modern banking systems. Around 3000 BCE, cities exploded in size. Farmers grew surplus crops, traders traveled vast distances, and people suddenly needed a secure place to store their valuable goods without constant worry. Where could you store grain and valuables where no one dared steal? The gods provided the answer. Massive temples became the very first secure vaults in human civilization, combining faith with finance. Priests managed these sacred storehouses with absolute honesty. People trusted the divine authority of the gods far more than any earthly ruler, making temples the safest institutions to hold surplus riches. Farmers brought their surplus grain to the temple granary. Instead of letting it rot at home, they stored it safely, receiving a stamped clay tablet as official proof of their valuable deposit. Those little clay tablets were revolutionary receipts. You did not need to haul heavy grain across town to buy things. You simply handed over the tablet, inventing the earliest form of paper money. With secure deposits established, temples realized something incredible. Not everyone withdrew their grain at once. Priests could lend out a portion of the stored reserves to ambitious merchants seeking new business opportunities. Loans came with a cost known as interest. Borrowers gladly paid extra because the borrowed capital helped them generate even greater profits on their trading ventures across distant foreign lands. As trade routes expanded across rivers and deserts, merchants needed standardized value. Temples began accepting precious metals like silver and gold, weighing them carefully to establish universal values. Independent merchant families began partnering with temples. They borrowed funds to finance massive caravans laden with spices, textiles, and precious metals, driving an unprecedented economic boom throughout the region. Every single transaction required meticulous bookkeeping. Scribes pressed reeds into wet clay, recording names, amounts, and repayment dates with absolute precision to ensure trust remained intact across every deal. Not all ventures succeeded. If a caravan was lost to bandits or storms, borrowers struggled to repay. Ancient societies needed formal rules to handle debt, defaults, and financial disputes fairly. Enter King Hammurabi of Babylon. He carved strict laws onto giant diorite steels, establishing clear legal frameworks for interest rates, loan terms, and severe penalties for fraudulent banking practices. Hammurabi laws protected both lenders and borrowers. This crucial legal foundation transformed banking from a risky gamble into a reliable, structured pillar of stable ancient civilizations. As empires rose and fell, banking concepts spread across the ancient world. Phoenicians, Greeks, and Persians adopted temple banking and refined it to support their own rapidly expanding maritime trade empires. In ancient Greece, famous temples like Delphi functioned as massive international financial hubs. City-states stored their treasuries there, and priests exchanged foreign currencies for local travelers. With dozens of different city-states issuing unique coins, money changers set up small benches in public squares. They evaluated metal purity and exchanged currencies for a small fee, creating the word bank. The Roman Empire took financial systems to an entirely new level. Roman bankers, known as argentari, managed private accounts, accepted deposits, and executed complex debt settlements across 3 continents. Romans invented early letters of credit. A merchant could deposit funds in Rome and withdraw them in Alexandria using a secure written document, eliminating the deadly danger of highway robbers. When the Roman Empire collapsed, centralized trade fractured. Europe entered the Middle Ages, where banking shrank dramatically, and local bartering temporarily replaced complex financial networks for centuries. Meanwhile, the Islamic Golden Age experienced a brilliant commercial renaissance. Muslim merchants developed sophisticated credit networks, checks, and partnership contracts that spanned from Spain to China. Islamic traders used a written order called a sak, meaning check. A merchant could cash a sak in Baghdad for funds deposited in Cairo, making long-distance trade remarkably safe and efficient. During the Crusades, the Knights Templar military order created Europe's first multinational banking network. Pilgrims deposited funds in Europe and withdrew them safely in Jerusalem using coded letters. By the late Middle Ages, Italian city-states like Florence, Venice, and Genoa became the beating heart of European commerce. Clever merchants revived banking on an industrial scale. Italian bankers operated outdoors behind wooden benches called banches. If a banker failed, angry citizens would smash his bench, a violent practice known as banca rota, or broken bench. Math genius Luca Pacioli published the revolutionary system of double-entry bookkeeping in 1494. Every debit had to match a credit, bringing total mathematical clarity to financial accounts. The Medici family of Florence built the wealthiest banking empire in Europe. They opened branches across major cities, financed kings, and funded the glorious artistic masterpieces of the Italian Renaissance. Medici bankers perfected the bill of exchange. This ingenious financial instrument allowed money to be transferred internationally, while quietly bypassing religious bans on charging interest on direct loans. As trade exploded, private banks occasionally failed. Cities demanded stability, leading to the creation of the first state-backed public banks, such as the Bank of Venice in 1587. Public banks began issuing paper banknotes backed by deposited silver and gold coins. People quickly realized trading lightweight paper notes was far easier than carrying heavy metal coins everywhere. 17th century Amsterdam became the financial capital of the world. The Amsterdam Stock Exchange and Wisselbank introduced modern centralized banking, transparent exchange rates, and fractional reserves. Bankers discovered that depositors rarely withdrew all their money at once. By keeping only a fraction of cash in reserve, they could safely lend out the rest, fueling unprecedented economic expansion. Founded in 1694, the Bank of England revolutionized national finance. It lent money to the government, issued standardized paper banknotes, and acted as a lender of last resort. With stable central banks backing currencies, global trade exploded. Ships sailed across oceans connecting continents, financed by joint stock companies and international banking syndicates operating across borders. The Industrial Revolution demanded astronomical amounts of capital. Banks financed massive factories, railways, and steamships, transforming agrarian societies into modern industrial powerhouses virtually overnight. National currencies backed by gold standards replaced fragmented local coins. Paper money became universally trusted, allowing everyday citizens to participate in commerce like never before in history. To manage millions of daily transactions, banks created clearing houses. Instead of running between rival institutions with bags of gold, bankers simply exchanged checks and settled net differences daily. Rapid growth brought severe risks. Bank runs occurred when panicked depositors demanded their cash simultaneously. These crises led governments to create central regulatory bodies and deposit insurance programs. Banks opened their doors to the general working public. Savings accounts allowed ordinary families to earn interest on small deposits, turning everyday citizens into active investors in the economy. The mid-20th century introduced credit cards. Plastic cards replaced paper checks for everyday purchases, allowing instant borrowing and transforming consumer spending habits across the globe. ATMs revolutionized banking accessibility in the 1960s. Customers could finally withdraw cash, check balances, and deposit funds 24 hours a day without ever speaking to a human teller. Computers replaced paper ledgers. Electronic wire transfers and database networks allowed trillions of dollars to move instantly between global financial capitals at the speed of light. The internet brought banking directly into people's living rooms. Customers could check balances, pay bills, and manage investments from home computers, eliminating physical bank visits entirely. Smartphones put a powerful bank in every pocket. People could transfer money instantly, deposit checks by taking photos, and track spending habits in real time wherever they traveled. Tap-to-pay technology and digital wallets made physical cash nearly obsolete in many nations. Purchases happen with a simple wave of a phone or smartwatch, continuing an ancient evolution of convenience. Blockchain technology introduced decentralized digital currencies. Without traditional banks or central authorities, people could transfer value peer-to-peer across the globe using cryptographic ledgers. Modern algorithms evaluate credit risks instantly, detect fraudulent transactions in milliseconds, and provide personalized financial advice tailored to millions of users simultaneously. Digital banking brings financial services to remote populations who never had access to traditional brick-and-mortar bank branches, empowering entrepreneurs in developing nations to build thriving businesses. From clay tablets in Mesopotamian temples to encrypted digital ledgers, banking has always been fundamentally about one essential human concept: trust between strangers cooperating to build a better future. While vaults have moved from stone temples to heavily encrypted cloud servers, the core mission remains unchanged. Protecting hard-earned savings allows human ambition and commerce to flourish safely. Money sitting idle achieves little. By channeling savings into productive loans and investments, banking transformed stagnant wealth into the driving engine of human innovation, art, and science. We have traveled an extraordinary distance from trading sacks of wheat and stamped clay tokens to managing global wealth with silent digital impulses across invisible networks. Every financial innovation in history was born from practical necessity. Understanding this remarkable journey reveals how human ingenuity continuously solves complex societal challenges through cooperation. As financial technology continues to evolve at breathtaking speed, we stand on the shoulders of ancient scribes and Mesopotamian priests who first dared to imagine a safer way to store value. Those humble clay tablets pressed in ancient dust laid the permanent groundwork for every modern bank, stock exchange, and digital wallet we use effortlessly in our daily lives today. Banking is not just about numbers and money. It is the enduring story of human connection, trust, and our collective drive to build a prosperous and secure civilization together. From temple granaries to decentralized networks, the fundamental quest for financial security remains our greatest shared achievement across thousands of years of human history. As we look ahead to the next chapter of monetary innovation, remember that every great financial leap starts with trust, collaboration, and a brilliant idea to solve a human problem. History proves that systems change, but human ambition never does. Thank you for joining this incredible journey through the fascinating origins of banking and human economic evolution. What financial invention do you think will shape the next 1,000 years of human history? Drop your thoughts in the comments below, and remember to subscribe for more amazing historical stories related to finance.